Welcome back to my channel. Welcome back to my channel. My name is Lukman. Thank you for watching my videos, and I would like to let you people know that all the information that I'm sharing here is for educational purpose and not a financial advice. And if this is the first time you are coming across the video, please help me subscribe, like, comment, and share the video with your loved one, and click on the bell icon so that each time I drop a content like this, the YouTube will notify you. So before we continue, I will be talking about divergence trading and the type of divergence we have. We have two types of divergence. We have regular divergence and hidden divergence. Well, we lay more emphasis on regular divergence. Like I said, we lay more emphasis on regular divergence. And like I said earlier, the system is a very good system. You don't have to be running from one trading system to another. All what you need to do, just pick one trading system, practicalize this on demo account as many times as possible, journal your result down, and if you are comfortable with the results that you got on demo, you go ahead to live account and start placing your trade. Don't play with your trading journal. Your trading journal is your breakthrough. Even though if you lose a trade, each trade you lose, you learn something there. So keep your trading journal. Always write your trading journal down. Why you take the trade, where you want to take profit, where you want to put your stop loss, where you intend to exit the trade. So even at the end of the day, you now go back to the trading journal. It will help you, it will guide you, it will help you to fine-tune your trading system. You don't have to be running from one trading system to another. Just one trading system is what you need for you to be successful. Maybe nobody have told you this, but you may be hearing this for the first time. One trading system is enough for you to be succeed. You don't have to be jumping from one trading system to another. So like I said, we have two types of divergence: bearish, hidden bearish divergence, and regular bearish divergence. We shall be lay more emphasis on regular divergence. And the two types of regular divergence we have is bearish regular divergence and bullish regular divergence. First of all, let us go to bearish regular divergence. And bearish regular divergence occur in an uptrend when the trend has been going up, it has been going up, and the oscillator is not diverging from the price. If you have not watched the first video on where I explained the indicator we are using relative strength index, RSI indicator, and SMA 20, that is simple moving average 20. That's what we are using. So, and in the first video, if you have not watched it, you can go back and watch the video for better understanding of this one that I'm talking about. So divergence occur in when the price is diverging from the oscillator. Ordinarily, if the price is going down, the oscillator is supposed to be going down as well. But in a situation where the price is going up and the oscillator is going down, that is divergence. The price is diverging from the oscillator. So, and the indicator we are using is the indicator that we're using to show us the divergence is RSI, relative strength index. Is a very good indicator, and it's a lagging indicator. What I mean by lagging indicator, it does not give fake out. So once it tell you this is what is happening in the market, is the prediction is accuracy. It doesn't give fake out. So bearish divergence occur when the market has been an uptrend, but the oscillator is now diverging from the price. It's now telling you that something is about to happen and it alerts you on time. For instance, let's go to CHF Japanese yen monthly time frame, and don't forget this this system is very good, but don't take the system for granted. Like I said, the system is good, but don't take it from that. Listen to my instruction. It will help you to go in a long way. This system, don't trade this system on a lower time frame. Please and please, don't trade this system on a lower time frame. We are going to use the time frame we are using is going to be daily time frame to monthly time frame, because big time frame e give accurate analysis. All those lower time frame, I'm not against it. I'm not against what are using it, but what I'm trying to tell you about this lower time frame, that there's a lot of noise in the lower time frame. So we are using a bigger time frame. We are from daily, weekly, monthly. By doing so, it will give you accuracy. Like if you check I've told you before that if you follow this system, you will win at least 65% of your trade. And if you can have a 65% winning trade on your trade on a monthly basis, if you can do that annually or consistently, you are very good. You are far better than a lot of traders out there. So like I said, we are using CHF GPY, Swiss franc Japanese yen, as our example on monthly time frame about this bearish regular bearish divergence. This is CHF JPY on a monthly time frame. Don't forget the indicator we are using is RSI, Relative Strength Index, and the simple moving average SMA20. That's what we are using. Now let's look at the price. Like I said earlier, divergence, when the price is diverging from when the oscillator is diverging from the price, that's when we have a divergence. And look at ordinarily, you can see the price here. This is the high, and market make another high. Look at this high. Look at this one now. This market is also expected to make another high. The oscillator is expected. Now that the market has making, look at the price here. This is one high. Now later on, the market broke this level and shoot up, isn't it? Now look at what the oscillator is doing. Look at this high. So at this level, we are expecting the oscillator to make another high, breaking the previous high. Look at the previous high. We are expecting the oscillator to make another high and break this previous high and go up the same way the market. Look at this high. The same way the market broke this high and skyrocket. But what happened? Reverse was the case. What happened? Look at what the oscillator is now doing. The market was the price was making higher high. That is, look at one high here. Let me use this thing for better understanding. Look at this high, 179.832 was our previous high here as at July 2024. The market pulled back a little bit and shoot up and and broke the previous high, which is 179.832. Broke it up, and the market continued to skyrocket. But what is our oscillator supposed to follow the suit? Here's the oscillator. I'm trying to do so that you get a better understanding of it. Look at our oscillator. Look at this. Look at the price here. The price broke this level. The oscillator was also expected to break this level. Look at our recent high, which is this 81 level. When the price broke this resistance, which is 179.832, the oscillator was expected to also break this 81.11 level and suit up and follow the price. But what happened? Reverse was the case. As the market was making higher high, what is the our oscillator is doing? Our oscillator was making lower high. Remember what I said, as the market break the previous resistance and suit up, the oscillator is supposed to follow the trend as well and suit up. But what happened? The oscillator was making lower high while the price was making higher high. It's not telling you that the oscillator and the price, they are divergent from each other. That's to tell you that reversal is on the way. Reversal is coming. Reversal is about to happen. Look at what happened here now. Since the market has been going up and going up, we started tracking the market and continue to look for a good position to sell, to take our sell entry. Now we have taken the sell entry from the high, and we are using, like I said, we are using simple moving average, this moving average as our take profit target. And look at what happened now. This trade is going to be a long time. It may take 2 to 3 months before it hit the target, because this is monthly time frame. It means that one candle will form just in a month. In the whole year, it will only form 12 candles. So this is where we are expecting the market to come. The market will return back to the moving average, and we are expecting to come here. That's what the divergence trading is. So that is example of regular bearish divergence. So as the months keep on going, I will keep you guys updated on the price and the progress of this trade. So that is all about bearish regular divergence. And in some cases, in the market, they said you don't go broke by taking profit. So this is, once the market is approaching this simple moving average, I'm going to take profit, because the profit you have not taken is not your own. So I will not like to give back to the market what I've earned. So that's why I set my take profit close to the simple moving average. That does not mean market cannot go down. Market can go down beyond this level, but this is where I would like to take my profit. And if you are in this trade and you like to go beyond this level, you can use trailing stop loss, so that as the market continues to go down, your trailing stop loss will continue to help you track the market, so that you will not give back to the market what you have earned already. So that is all about hiding bearish divergence. The second one we are looking at is hiding that's all about regular bearish divergence. The second one we are looking at is regular bullish divergence. And what is regular bullish divergence? Regular bullish divergence is the opposite of regular bearish divergence. Because the regular bearish divergence, it occur when the market is uptrend, and when the oscillator is not diverging from the price. The same thing applicable to regular bullish divergence. It occur at the downtrend. After the downtrend, regular bullish divergence occur. It occur when the price is diverging with the oscillator. When there is a disagreement between the price and the oscillator, that is when we what they call it, regular bullish divergence will occur. So let's look for example of regular bullish divergence. Let us look at Great Britain pounds, Australia dollar weekly time frame. So this is Great Britain pounds Australia weekly time frame. Like I said, higher time frame give accurate figure. And one thing about divergence trading, the accuracy is very high. If you can master the system, the accuracy is very high. Now, this is the way to go about it. Divergence trading, it will not give you much trade. It will not give you much trade. If you are the type that you want to place like 10 to 20 trade in a month, divergence trading is not for you. But if you are the type that you want to trade less and make more money, divergence trading is for you. Because sometimes in the whole month, you may not see, you might not see more, you may not even see up to 4 trade. I'm very serious with you. What I'm saying, you might not even see up to 4 divergence trading. Sometimes in a month, you may only see 2 trade. Sometimes within a month, you will only see 3 trade. But if you are well analyzed, even though that 3 trade, you can win 3/3. Even though that 2 trade, you can win. Even though within that 3, you can win 2/3. That was why I said it will guarantee you at least a minimum of 65% accuracy, or even not 70%. And if you can make 65%, if you can get your trade right 65% or even more than that, you are far better than a lot of people out there. Now let us look at Great Britain pounds, Australia dollar, weekly time frame. What is happening here now? Let me highlight the level. Here is our support level, and here is another. Here is what the oscillator is saying. Let me just put this in another way. Okay, little bit. Okay, look at what the price is saying and look at what the oscillator is telling us. This level you are seeing, this is 1.87128. It's a support level. It's a support level. Look at the level. Price reach here and went up a little bit. That is the pullback. And it came back. It came back to broke the previous support, which is this, which our support, which I put the horizontal line, which is 1.87122. The price, after when the price got here, it pulled back a little bit and now went down to broke the previous support. And now I'm making new low at 1.85601. But let us look at our oscillator now. What is our oscillator doing? Price got here and pull back. As the price break the previous support, we are expecting the oscillator. Look at the oscillator here now. We are expecting the oscillator as well to break this 19.6 level and come down. We are expecting to break this level and come down. But guess what happened? The oscillator did not go down. Instead, the price was making lower low. Like the recent low is lower than the previous low. But what is our oscillator doing? What is the oscillator doing? The oscillator is making higher low, as in the oscillator refused to be lower than the previous low. Look at the price here now. The market got here, pull back a little bit and make a new low. Look at the oscillator here now. The oscillator refused to make a new low. That is now telling you that the price is diverging from the oscillator. That is, The oscillator and the price, there is disagreement between them. And when there is a disagreement between your oscillator and the price, it's telling you that something is about to happen. And you can see the trade, this trade now, it has been a downtrend for a very long time. And look at what is happening now. Look at what is happening now. Price make lower low, but the oscillator is making higher low. It's making higher low in the sense that as the price break this level and come down and make a new low, oscillator was also expected to come down and make a new low, but it refused to make low. It started shooting up. It's now telling you that there's a disagreement between the price and the oscillator. And when there's a disagreement between a price and an oscillator, that is when you see an opportunity. That is where you spot an opportunity. It's telling you that something is about to happen, and it will help you to act fast. So we started looking for a trade. We started looking for a bullish signal here to take an entry and use our weekly and use our moving average on a weekly and take profit. And look at what happened. The market started from here. May 17. The bullies started from here. Boom. And got here. Like I always tell you, personally I use simple moving average 20, this red moving average, as my take profit. That does not mean that market cannot go beyond this level, but once the market reach this level, I'm taking my profit. So that is what regular bullish divergence is all about, and that is what regular bearish divergence is all about. For the first time, you might find this so confusing, or you might find it difficult, but as on a weekly basis, I will try to post a video, and if I'm less busy, I will also post a video during the midweek to keep on reminding us the trade opportunity and the setup. So by the time you watch this video and over and still watch the upcoming video where I'll be sharing the trade setup ahead of the week, you will be familiar with this system. All what you need is money. It's not enough. Then you need to know that it is not the number of trade that you take that will guarantee you money. It is the number of quality trades. Divergence will not give you that plenty trade that you are expecting to get. It will give you a few trade with a quality setup, and your risk to reward is on a high side. So I hope you find this video helpful. If you find the video helpful, please help me subscribe, like, comment, and share it with your loved one. And don't forget to click on the bell icon so that when I drop a video like this, the YouTube algorithm will automatically notify you that I've dropped another quality video. Thank you very much.